Hello everyone, I'm Irfan and welcome to Expert Take, powered by Yubi, world's first possibility platform. Today we have Mr. Shachindra Nath, our expert and guest, talking about his take on how co-lending powered by technology is accelerating MSME lending in India.
Thank you, Irfan. Thanks for having me.
Welcome, sir. Pleasure to have you on our Expert Take series, sir. Quick introduction. Mr. Nath, Vice Chairman and Managing Director of UGro Capital, has been instrumental in building two insurance companies, a large asset management company, and an NBFC earlier. He has established new business verticals alongside foraying successful joint ventures and partnerships for the group. Currently, Mr. Nath is focused on reducing MSME credit gap in India and is committed on building a strong SME financing platform driven by technology. Thanks again for joining us on this Expert Take, sir.
Thank you.
Sir, going on your favorite challenge that you are trying to solve for the country and for UGro at UGro, the first question is, how critical are MSMEs in India's growth story, and how are we going about it at UGro and in general in the financial services sector?
No, it's a very good question. I must have answered this question thousands of times. I think so. The way, I don't look at just it as a segment of the credit opportunity. The way I look at the role what an MSME or a small business play in India is multifold. India lives in its, not in just top 10 cities. India lives in, its tier 1, tier 2, tier 3, tier 4 towns. And for managing and maintaining our socio-economic balance, we need to ensure that people get employment in their respective, cities and geographies. And MSME or small businesses play that role. Today, we have roughly around 11 crore MSMEs, roughly around 6.4 crore MSMEs in India, employing 11 crore plus people, contributing roughly around 30% of the GDP. And if, India has to succeed and survive and make sure that large portion of its population get employment, the only sector which can provide that employment is MSMEs, because we are not in so large an industrial nation, and anyway large industries operate in a cluster, which means that most of the time people have to come to these clusters and operate from there rather than being in their hometowns. So that's, I think, so where we are focused upon that. How do you make sure that these small businesses obviously achieve their potential and their new ones can continue to grow? The challenge, though, have always been for a small entrepreneur is to get timely access to the credit. This timely access to the credit has an age-old phenomena which has never been solved. The credit gap in India is roughly around $400 billion. And the outstanding MSME credit is only 23 lakh crore. And the reason for that is twofold. And it is not just the lender's responsibility. Historically, small businesses, the way they have operated, they were not credit enabled. So I keep giving this example. Think of lender going to a small businesses in a small town and asking that, tell me what is your revenue, tell me what is your expense, and what is the margin in the business, and how can I, see that? And for all these questions, the answer was that all of this is in informal, and I don't have any record to show. Now, if to a lender, if you say that, then he will resort to only lend you against a physical collateral, because he has no way to assess whether the MSME or a small business has the ability to pay back the both principal plus interest.
Yeah.
And I think so that is changing now. The role of data, what we call the data and tech, is exponentially changing this. So with the advent of GST and with the banking getting digitized, quite a large number of MSME are coming into the formal fold, wherein the lender's ability to assess both the revenue and the expense and what we call the three pillar of lending, the intent, the eligibility and ability, is quite digitized. And that's why we think there is an explosion and the future of India is quite safe and secure, because the credit dissemination to MSME in this decade would be highest what you have seen in last 5 decades.
Well said, sir. I think you've painted a picture on the demand side, the gap, huge gap that we see on the credit side, and then the opportunity that we have with the advent of technology and data, and the trifecta of intent, eligibility, and of course technology also. So, sir, with this, I go on to the second, leading question, which is, so in this context of significant gap in financial inclusion, how can co-lending model drive financial inclusion for a priority sector, that is MSME in question today?
So I think we have to go back a little bit of in last 5 years, why the co-lending as a regulatory framework was, needed, designed, right? So as you know, for non-bank finance company, the source of financing, unlike bank, is limited to what we call wholesale financing. So any non-bank finance company can go borrow from a bank. It can be a public sector or a private sector bank. It can borrow from capital market in form of mutual fund or NCDs, high net worth, or to some extent it can go and borrow from some of the global DFIs. Right? What has happened though, that over a period of last 7 or 8 years, we have seen certain events happening wherein banks lending to NBFC, and this has happened only for few, right? So bank lending to a DHFL or for an ILFS and for Altico and few others, money was given for a defined purpose, but it was utilized for something else. And predominantly because of that, banks had to suffer significant loss. While in overall context of total lending to NBFC, that amount is still small, but actually that broke the trust. Because if a large bank is giving a 500 crore term line for onward lending to small businesses and the money was utilized to do an wholesale financing, banks have very limited ability to control that, right? While they can have all contractual right, but on ground to control that is very limited. And that is what created what we call the liquidity squeeze. And that continues because, banks are very uncomfortable that if they give large sum of money to NBFCs, whether the money would be utilized for the end use purpose for which it is being given. Now, because of this whole concept, and UGro has been at the forefront of, getting this framework created in India, and we have been working very hard. What was believed that, so first and foremost, the role of the NBFC in the financial intermediation system was considered necessary. And that's why RBI, came back with this framework saying NBFCs are necessary for credit dissemination and especially to reach to the bottom of the pyramid or unserved and underserved market. But bank should rather utilize NBFC as an infrastructure to reach to that customer and co-lend with the NBFC, right? The benefit, what our regulators felt, that if rather than giving a, say, 500 crore term loan to an NBFC, if the same 500 crore loan has been given to 10,000 plus customer, the bank's exposure to NBFC is only limited to the servicing element of that. Yeah. But otherwise, the end use of the loan is not in question, right? So that's the premise on which the co-lending was built. Unfortunately, or fortunately, both ways, the way you want to look at it, is we are going through a process of evolution. Yeah. The first framework, which was a co-origination framework, expected the bank and NBFC to go together and jointly lend to the end customer. Now, historically, one of the reasons why banks which have all-pervasive distribution infrastructure and very large branch network have not been able to lend to the MSME segment with the same force because of the legacy, credit infrastructure and the method in which they assess the credit. So now in that scenario, if you expect bank and NBFC to do it together, that was kind of a failure. That's why in 2019, when the first co-lending circular came, UGro signed with 2 large banks, few others signed, but there was no credit which offtake happened under that. Now, it took roughly around 1 more full year for that to get changed, and then revised policy framework of co-lending came in which co-lending was made parallel to both, a co-origination or a co-lending model under what we call option 1 and option 2. Yeah. Under option 1, it is more similar to what was the 2019 guideline, wherein bank and NBFC can do it together. Under option 2, NBFC can pre-agree to a credit program, go and lend to the customer, and then T+2 day or T+1 day can transfer 80% of loan to the bank. So I think so in terms of regulatory guidelines, things have evolved. But obviously we'll talk about it, but there are operational challenges. And I keep saying that, a very senior, bank MD asked me this question, that why co-lending is not taking off. And my answer, I thought about it, and there was a laundry list of things which I could have told him. But I said, sir, think of this, it's like a South Indian young girl getting married to a Sardar boy, right? And both of them are, because they are young generation, so they don't care about their South Indian lineage and their, third lineage, and they are very happy to live together. But their families are still in their own cultural zone. Marriages are not about a girl and boy coming together. In India, it is also about their family coming together. So I think so the girl and boy have decided to come together, but the families are still taking time to work together, and that would happen over a period of time.
Very nicely put, sir, in very simple and understandable terms. But that's the significant challenge that we need to solve to make this co-lending model actually function. I'll come to that piece also later in my subsequent question. But I would like to answer one critical point in your framework of solving the gap. This is my subsequent question, sir. Is how is co-lending solving for India's systemic liability and liquidity problems that are there? When I say systemic liability, it could be from the perspective of the MSMEs that are needing those liabilities and liquidity options, and it also is to do with the NBFCs which are needing that liability and liquidity to be able to go.
So as I said, you think of that UGro got created, we got capitalized with 950 crore of capital in mid-2018. We started our business in April 19. April 19 to March 20, our first year, we funded purely our business out of equity, 850 odd crore. At the end of the COVID period, we were at 1350 crore. End of FY22, we are at 3000 crore. End of Q1, we are at 4000 plus crore, right? We are disbursing roughly around 1250 odd crore every quarter. In the previous era, without co-lending, co-origination, do you imagine that a 1200 crore of borrowing on balance sheet every quarter is possible? Answer is no. It is only possible. It has remained as a prerogative of few. Some AAA companies, AA plus companies, wherein there is a large Indian family or promoter, wherein lenders draw the comfort from not the business but the parentage. But for rest of the world, that kind of liability on balance sheet is still not available, right? Because when a lender lends to you, he's lending for an underlying portfolio which is, from a 3-year tenor to 10-year tenor. And, people are not being able to see that long tenor visibility, right?
Yes.
So obviously co-lending is solving to some extent that problem, because without that, the growth of the credit through NBFC is not possible. That is one. Number two, it is also solving the problem of what we call the asset liability mismatches, right? Because majority of the MSME financing in India, so there is a component of merchant financing and supply chain financing, which are very short tenor. Yeah. But otherwise, the MSME financing is technically tend to long tenor financing, especially if it is backed by some form of a mortgage. Because a MSME borrower, if he has a capacity to pay, say, 5 lakh rupees of EMI and has a defined collateral, then he would like to avail maximum amount of borrowing and fit the borrowing and its EMI to existing cash flow. Because his future cash flow comes over a period of time. And that elongates tenor, right? Because that's the only way you can increase the capacity of debt by elongating tenor. Yeah. Now, NBFCs don't get 10-year, 12-year financing, right? NBFCs predominantly, and especially non-vintage NBFCs, only get financing 3 to 5 years. Yeah. But when even if I borrow for a 3-year tenor and lend for a 10-year tenor, when I'm downselling that asset back to a bank under co-lending, that tenor is no longer, only 20% of that tenor is on my balance sheet, rest has gone to the bank's balance sheet.
Correct.
So both size of the liability and asset liability mismatch is being taken care of. Third, the end customer, because banks are willing to provide much cheaper cost, because banks' pricing for co-lending is not linked to the rating of the entities. So if UGro is currently A+ rated, my borrowing profile has a defined cost structure. I cannot expect my borrowing cost to go down to 7%, which means by force, I cannot lend, sub 13 or 14%. But under co-lending arrangement, because banks is treating it as if it is lending to the customer, the benefit of the pricing can also, finally is getting transferred back to the customer, which is making them more viable. Because MSME customers, their cash flow are sensitive to the total cost. And as you reduce their interest cost, they become more sustainable. So I think so all of this is, very, very significantly advantageous. I think the only challenge is that the amount and the size at which it should happen, it is not yet happening. And I think it's just a matter of time.
Absolutely, sir. You put it really well from the perspective of ALM as well, that you talked about ALM of someone like a UGro, and also from the perspective of ALM of the underlying MSME, which could have been assessed differently by a UGro or versus bank. So, sir, here a slight question is about underwriting the MSME borrower. The sharpness that is needed. You touched upon in the first question about NBFC's ability to, because they are so close, ability to underwrite it sharply, and then hence ability to take risk as well. So could you please comment on the underwriting or ability to assess risk by NBFC and then bank leveraging on this a bit, and in the context of GST and technology and data, if you could just elaborate for the audience.
Yeah, so I think so traditionally the approach have been, or thinking have been, that NBFCs are very close to their customer. Their credit officer can go meet customer and assess on the basis of that ability, and that's why they have better ability to underwrite customer than what a bank is. Now, we are not of the believer of that. I think so because eventually banks also have the same kind of infrastructure, people, branch, physical infrastructure. Our view is that it is the method of assessing the customer, and wherein we believe that the conventional underwriting method, which is the balance sheet led underwriting, versus we underwrite customer like what happens in the consumer loan.
Sure.
So let me give you an example. If you walk into a Chroma store and you want to buy a fridge, today you can buy it in 10 minutes time. You have to just give your mobile number. Your mobile number fetches your CIBIL score. Your score has a PD which is given on that, and that defines the loss ratio, and basis that an app or a system or a lender can say yes and no on tap. And in an hour's time, you can walk away with a fridge or a TV, in your car, right? No question asked. Now, can the same thing happen for an MSME customer? So can an MSME customer receive an order of 10 lakh rupees for which he rupees of working capital, against which he can go and buy material, process it and supply it to his, his buyer, and then receive the money? Answer is no. He can take anything from 1 month time to 3 months time to get that kind of a very quick working capital. The whole period in which he has to actually process and deliver the material. That we believe is going to change is, as what I said, is that our first point of interaction is not human, but is a machine, and is a machine which is assessing the customer basis his real cash flow. And what is a real cash flow? If you have done last 12-month business, which is reflective in your GST turnover data, if you have a digitized banking statement, which is reflective of your cash flow, if you have a bureau footprint as a business, right, a CMR score, and the underlying footprint on the bureau getting created, and some more surrogate analysis, our system has the ability to categorize our customer in 5 band, what we call ABCD band. It's called GRO score, and it comes back both how much this customer can pay, and also it can do probability, right? So when I do a GST pull, we analyze 400 parameters of GST. Not only we can look at the current turnover, we can look at the quality of the turnover, and we can also do probability analysis of this turnover going up or down, and on an applied margin basis, what is the real cash flow which can generate it. So I think so this is going to change the credit, because without judgment, a machine-driven assessment methodology would tell exactly how much loan can be given for what tenure at what price. Now, pricing is dependent upon on a defined probability of loss. If a type of collateral is coming with the loan, that defines the pricing. So, for a same, think of this. I have a customer which has come, and which has given me GST banking and bureau and other things, and I've come to an eligibility amount. If the customer is asking an unsecured loan, the pricing can be anything between 16 to 18%. But is offering as a self-occupied residential property as a collateral, pricing can be as low as 10 or 11%. It is not because the assessment changes because of the collateral.
Sure.
But collateral provides you a sense of security and what can be the loss given default. And in case of a default, that defines the pricing. So collateral would drive the pricing in our case, but assessment is otherwise digitized.
Absolutely. That actually sets up for the next question that I wanted to ask, and also this is an opportunity that I would like to thank for the partnership that we've embarked on between Yubi and UGro. Sir, how do you think is the Yubi and UGro partnership enabling credit access to MSMEs through a data-centric and tech-enabled approach?
Yeah.
To elaborate a bit here, sir, you touched upon the data, you touched upon machine doing the digital journey, and there is a tech approach to all the things that we are doing with, of course, surrogates and other kind of expertise that UGro has built in. And of course, there is a bank on the other side which has that kind of infrastructure, including today we have AA infrastructure as well. So bringing in all this together, UB being there, with you, and you have that kind of great expertise in terms of assessment. So what's your take on our partnership enabling credit access to MSMEs through data-centric and tech-enabled approach, sir?
So think of this way. In fact, around 2.5, 3 years, when we launched our co-lending platform called GRO Extreme, we thought that right from point of origination to integration with the bank, everything should be done by our platform, right?
Sure.
But then over a period of time, we realized that, our expertise is credit, point origination, reaching out to the customer, being able to underwrite the credit, take balance sheet led risk, and use all form of data and technology. But the last mile delivery integration, what we call the market infrastructure function, is not ours. Sure. Because the market infrastructure has to be neutral to a lender. Now, even if suppose I go and integrate with one bank somehow, but that integration, the time and effort for us and the bank is of no use, because that no other lender will come to UGro to integrate with a bank, because they will perceive us as either a competitor or a fellow. Or other way to think of this, when you order something on Amazon, right? When the order get delivered at your doorstep, at your door, that is not being delivered by Amazon itself. It is being delivered by a delivery or some other, a Blue Dart or other, right? Theoretically speaking, Amazon, given their size, or a Flipkart or any marketplace, given their size, the last mile delivery infrastructure also they should build. It's very profitable. The value of some of these marketplaces or the delivery infrastructure is going multiple fold. But it is two different domains. Amazon's job is to bring the best product at best price, and customer being able to find which is most suited, right?
Yeah.
But once the order button is pressed, from picking up from a warehouse and delivering to your doorstep, and if you don't like to, then picking it back again to the doorstep again of the warehouse of the Amazon, is not Amazon's job, right? So I think so. UB and UGro are like that. You're like Amazon, whose job is different, and you're like a delivery whose job is different. So I think so. We understand our domain. You are a market infrastructure. We benefit. So today we have tie-up with 12 banks. You have, integrating yourself with almost every financial institution or a lender. So some of them would access now UGro through you, and we will access, all of our existing co-lending partners would get access through you. But your job is to create that market infrastructure which provides seamless integration with all these banks, not just on co-lending, but other things. Now, these banks and financial institutions can deliver you co-lending, securitization, term lending, many other kind of things.
Absolutely.
And we are better off doing it through you rather than doing through ourselves. And I think so that's why we have decided, and we think so that, and also I don't think so that space is large enough wherein 10 such players would be there, right? So in India, we have only one national stock exchange and one Bombay stock exchange. Can we have 5 more exchanges? No. So National Stock Exchange doesn't create stocks. The company is the issuer and investors are the buyer. They are only providing a market infrastructure. So we see Yubi like a national stock exchange providing a market infrastructure which connect the financial institutions to people like us and eventually also retail investors. So I think so this partnership will go a long way in enabling the credit to multiple in multiple ways.
No, thanks for putting that again easy to understand, sir. And key points to note are the market infrastructure. Neutrality is one of the key pieces, and then bringing in the players, the co-lenders together. And another point that you mentioned, sir, especially in the context of MSME, is a supply chain financing, which is another very important product for us to be able to think about and execute. This is again, beyond trades and other such platforms. There is a huge opportunity there for us to work together as well.
Sir, very quickly on the supply chain, I think so trades solve the problem of only vendor ecosystem.
Yes.
Trades is nothing but a off-balance sheet corporate exposure. Actually, the bigger pain and challenge in supply chain is the bottom stream, or what we call downward stream.
Yeah.
When a large manufacturer is distributor, it's wholesaler, it's retailer, the offtake of material or purchase credit is something which is massively challenging, and that's where the problem has to be solved. So I think so in the supply chain that is where the opportunity is, and we are working very hard of our own and also with partners like you to solve for that problem.
Thanks, sir. Sir, I think while the regulator has created this. Taken this forward-looking view and then created this framework for all of us to come together and all lenders and co-lenders to come together and solve this big problem of credit for MSMEs. There, like you in the beginning touched upon saying that this model is again, you worked on it for a year, then shared your perspective and views in terms of this still not scaling up. And then here we are today with 2 options, co-lending model 1 and co-lending model 2. Definitely giving a significant positive outlook, and then there is some bit of offtake as well. But then this is still evolving. We still see that a lot of stuff has to be taken care of. And you gave an example of a South Indian and a North Indian couple getting together, but families yet to come together. So, sir, in this context is my next question. What should be our ask, and then what are the key changes in regulations that you see and are required for co-lending model to function very efficiently and more importantly effectively?
I think so Yubi can play a very large role in what we call the policy propagation. So I think the biggest hurdle in the co-lending today is not about the intent. Almost every bank, now including private sector banks, understand that co-lending is really profitable for them. It scales up, but there is still a lot of resistance, and as well as they are hesitant to do that, and it is for one simple reason. I go back to the same, South Indian girl and North Indian boy, right? So a vegetarian family and a non-vegetarian family, if they have to live together, what is the promise they will make to their respective parents, right? So the North Indian boy would say to the South Indian girl that when your family comes our house, we will not cook non-vegetarian, right? And the South Indian girl would say, when your family would come, I would have no problem, we having non-vegetarian food. Now, if you have to arrive at that, if I go to a bank and bank has done credit in a particular way, and when I say that we have to do a loan on a 80-20 basis, you have to rely completely on our credit underwriting. But by the way, if the loss happens, then you and me have to share equally, right? Now I'm earning a margin of 5%. Now, if the same bank would have given me a term loan, so think of a bank when it gives a term loan to an NBFC at say 9% and the NBFC lends at 15%, I have a capital cushion, which means that the term loan is never loses money, right? Because my equity capital actually is the buffer for all losses to get absorbed. So which means that on my balance sheet lending, I earn the margin basis my capital, versus in my co-lending, I'm earning the margin without deploying any capital.
Yeah.
So I have a question, and I would expect, and now actually it is even our digital lending guidelines technically are saying that the first loss covers can be given. Yeah. So if the regulations allow some form of first loss cover to be given under co-lending arrangement, which I think so is legitimate, then this would explode big time, because banks would draw the comfort with the underlying origination capacity, underwriting, but also some form of a credit enhancement which is coming through that. And also it is, why I say it is legitimate, because you are earning in a spread basis some kind of and I think so that NBFCs would behave more prudently if there is a first loss cover which is allowed. I think so RBI view have been that as soon as they allow some kind of first loss covers, banks become passive in their assessment. But I think so at some point in time, banks are still passive in their assessment, and that's why it is not allowing the expansion of credit through co-lending to happen. So time is here to actually allow that. So what has been given in digital lending guidelines should be expanded to co-lending as well. And I think so if Yubi can, it is counterintuitive for an NBFC to say that. But I'm saying in the interest of the entire co-lending, volumes and businesses to go up, some form of FLDGs should be allowed in co-lending as well.
Fair point, sir. I think as long as the market participants have the incentive alignment, so that their incentives are aligned and then it is aligned to scale and then make the entire program, market and model effective in terms of scaling it, I think it's good. It's win-win for everyone in the market. So very well put, sir. I think it was a great discussion, sir. As always, a pleasure interacting with you and then sharing and then noting your thoughts. Thanks so much for joining us on this session of Expert Take, sir. Can't thank you enough. And for all our audience, stay tuned for more such interviews with experts who are transforming the credit ecosystem through technology to fuel India's credit growth. Thank you so much.
Thank you, Irfan. Thank you so much.
Thank you, sir.